Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled, How Lower Interest Rates Boost the Appeal of Dividend-Paying Stocks. Now, we know in times of economic uncertainty or monetary easing, we know the Fed will lower interest rates to stimulate growth and investment. And while the focus on those actions is typically on borrowing and spending, one of the less obvious beneficiaries of these lower rates is dividend-paying stocks. Right? Lower interest rates create an environment in which these stocks become more appealing to income-seeking investors. Now, there are several factors that do contribute to this, so let's talk a little bit about them. Number one is cheaper debt. When interest rates are lower, companies that issue dividends can borrow money more cheaply, we know. This can help companies fund their operations or expand more affordably without having to cut their dividends. And then finally, the companies with lower borrowing costs are also better positioned to sustain or even increase their dividends. Another factor there is increased consumer spending and economic growth. So another general effect of lower rates is that it's going to stimulate the economy by encouraging borrowing and spending, as I noted before. This leads to improved corporate earnings, benefiting companies that pay dividends. So it's a very general, overall healthy thing for the company's earnings, right? It makes it easier for companies to maintain or grow their dividend payments. Now, to me, the most important one or the most attractive benefit is the yield comparison. Right? When interest rates are low, the yields on fixed income investments like bonds, or, whether they're corporate bonds or T-bills, T-notes, savings accounts, CDs, they tend to decrease. Dividend-paying stocks become more attractive in comparison because their yields, of course in the form of dividend payments, may be higher than what's available from those lower risk investments. So investors seeking income might turn to these stocks for better returns. So that's really the foundation of what we talk about. But what I also want to address is, okay, if that's going to be the narrative, if we believe the Fed is going to begin a cycle of lowering interest rates, how do we prepare for that now? How do we find the best stocks at the right time to take advantage for the income-minded investor? I can't do a presentation about dividends without using Dr. DeLito's quote from Stock Strategies and Common Sense. He said it's the best of all worlds, right? Collecting dividend checks while prices of your stocks go up. It comes from finding solid growth stocks that pay dividends. And VectorVest is ideally suited to find these babies. That's just classic Dr. D. So what I hope to do here in this presentation first is lay a quick foundation with some definitions and how VectorVest analyzes dividends. But more importantly, I want to show you how to use VectorVest to find dividend payers, the right ones at the right time, and how to build and manage a quality income portfolio. Now, overall dividends play an important role in generating equity total return, right? I looked up this number in several different places, so I'm just giving a general context of it, right? Since 1926, dividends have contributed approximately 30 to 40%. The general theme is about a third of all total return of the S&P 500 come from dividends. So we know it's an important role, and that doesn't even include, the power of compounding and reinvesting those dividends. Okay, so that's an important place to start. I want to talk a little bit about dividends, the dividend yield. Some of this is basic. Again, before I jump into the program, I'm going to touch on some of the basic definitions. So a dividend, what is it? It's a distribution of a portion of a company's earnings to its shareholders. Dividend yield is the amount that the company pays out relative to its share price. So when I talk about dividend yield, it's just simply the annual dividend per share divided by the price per share. Right, those are industry standard numbers, and we'll talk about those. A couple of dates that are a few dates that are important. I've highlighted the execution date or the ex-dividend date. I think this is perhaps for the individual investor most important. You have to know that the ex date is the date before which you must own the security to receive the dividend. In other words, if you buy the stock on the ex-dividend date, you're not going to be entitled to the next dividend payout, right? You have to wait till the following dividend payout. Finally, we'll talk about the VectorVest dividend indicators. I've already mentioned the annual dividend, the dividend yield, and then we have highlighted here the VectorVest proprietary indicators that we use to rank and analyze our dividend payers. So dividend safety, dividend growth, along with yield gives us the YSG, or the yield safety growth vector, which again we'll discuss and talk a little bit about as we get into the program. From the home page here, the first thing I want to do is go to the Viewers tab along the main toolbar. And when I click on Viewers, it will take us to, I have it set to our watch list viewer here. Of course, we have our other viewer sections here. I've got it set to the watch list viewer. And what I'll do, I'll start at dividend payers and I'll open up that portfolio. And as I've discussed also in past presentations, we've talked about the DRIP watch list. It stands for the Dividend Reinvestment Plan. We have one list that takes companies that have not only paid but have grown their dividend for at least anywhere from the last 5 to 9 years. We have the DRIP watch list where they've grown their dividends 10 to 24 years. And then, of course, usually where we head to first is the DRIP 25 plus. These companies have not only paid but have grown their dividends for at least 25 years or more. Now, they're similar to the Dividend Aristocrats for those who might follow those. Currently, there's about 65 or 67 companies on the Dividend Aristocrats. That is, again, companies who have not only paid but grown their dividend. We have 125 on our list here. The difference is the Aristocrats have to be currently listed in the S&P 500, so that's the difference here. What I'd like to do is just break this down a little bit, and we'll take a look at some of these companies. I just want to quickly go through on the slides I showed what we were looking at here. This is the VectorVest indicators that rank and analyze the dividend portion of this. Dividend and dividend yield, we talked about. These are the basics, right? This is the annual dividend, the yield based on the price of the underlying stock. Dividend safety, growth, and YSG is what I pointed out on the slide. And so dividend safety, it is the one proprietary indicator in the VectorVest program that goes on a 0 to 99 scale. Now we say that line in the sand for dividend safety is at 50, right? Anything above 50 is going to help to solidify the idea that what we're looking for is that the payout ratio is fair, right? Anything with a dividend safety above 50 will have a payout ratio that is favorable, meaning that if you compare earnings per share to the dividend or earnings yield to the dividend yield, you'll see that the company has the ability to hopefully to continue paying and growing those dividends, right? If they're paying out more dividends than they're earning, the chances are slim that they'll be able to continue to grow those. Now, there are MLPs and some other closed-end funds that are a little different. They're mandated to pay out more dividends, but I won't get too far into that right now. I just want to look at these basic numbers here. So overall, the dividend growth, again, is a forecasted number that we look at in the VectorVest program, a proprietary indicator. That's in percent per year, that number. And then we take yield, safety, and growth, and as I noted, we turn it into that vector YSG on the 0 to 2 scale, anything above 1 being favorable. So that's what we're looking at here. Again, the DRIP 25 plus list, and that's a quick review of what we look at in our dividend indicators. So there are some other lists here that you can choose to take a look at. Closed-end funds, master limited partnerships, monthly dividend payers. But what we're going to focus on now is looking at, again, these DRIP are a great place to start. You can create watch lists, look at some graphs and go through. You can cherry pick through them if you choose to. What I want to do is take us next into the Unisearch tab. Now here in the Unisearch tab is where we're going to obviously find all of our built-in searches here, and we're going to focus on some of the dividend paying searches. So I want to, again, as I noted earlier, show you exactly where to find these quality dividend stocks so you can prepare for the environment that we believe is coming, and building that attraction to these dividend payers. I have up here blue chip dividend payers. I'll start here. It is found in the folder Searches Retirement. And when I click on that folder, you'll see a handful of searches here that are related to dividends. I'll talk about a few of them, but first we'll start with blue chip dividend payers. And very basic, straightforward search. I only want familiar, mature, well-known companies, right? So I start with Dow Jones Industrials, Transport Utilities, and the S&P 500. To make the list, the dividend yield has to be equal to or greater than 3%. And it has to be on at least the DRIP 10 to 24 or 25 plus, because we want a good history of dividend growth. And then the dividend safety, as I noted, greater than 50. Finally, the sort, earnings growth rate times dividend growth. It's important because if for a company to continue to pay their dividends, of course, they have to continue to grow their bottom line. Otherwise, they're not going to be able to afford not only to grow, but even to pay those dividends. So this is blue chip dividend payers. If I slide over a bit, we'll see those dividend numbers again, and you can see the yield. Again, at least 3%. It's higher on many of these top stocks. The dividend growth and dividend safety meet the criteria we need. Earnings growth rate is there. It's one of the few times I'll advocate stocks that don't have a very high relative safety number. Again, the idea here is the more mature company with the free cash flow, which is what these companies represent. So a great one there. Another wonderful search for dividend portfolios. Vector plus Vector 1.25 is a search I wanted to point out. If we take a look at the parameters here, all we're looking for are stocks that have a VST greater than 1. They must have a relative safety number greater than or equal to 1.25, which is a very important number for these type of stocks, because we're starting to look for not just the dividend payout, but here, as Dr. D noted, the best of both worlds, where you're able to get both capital appreciation and the dividend payouts as well. So the earnings growth rate has to be strong, relative safety has to be strong, and then we sort them by VST plus YSG. So when I run this search, we're going to see, again, a lot of familiar names here. If I scroll over, let's go take a look at some of the other numbers. Now, well, first of all, we'll look at the fundamentals of the company, and relative value, safety, and timing are all very strong on these companies. Comfort index, right? That price growth persistence. Again, what we're looking for is both capital appreciation and dividends. You'll see the dividend yield's not quite as strong as blue chip dividend payers, but that's the compromise you make, right? You look for, the higher capital appreciation or the higher dividend payout. As I'm going to illustrate in a bit, that doesn't mean that the blue chip dividend payers don't provide you with capital appreciation. I'll show you those in a bit. Okay, but because the relative safety numbers are so high, the dividend safety numbers are also very high here for Vector plus Vector. From here, I'm going to take us to another folder. I'm going to take us to the conservative folder. There are several really good searches in here. Pale blue chips is one that I like. We use in our retirement coaching group as one of our model portfolios, performing really well. Again, relative safety a key there, and it has an indicator for each individual dividend indicator. I always like that about pale blue chips, and you'll see this is very similar to VST plus YSG. Buy-rated stocks along the top of this list. Really good relative value, safety, timing numbers. Comfort index is up. And again, the dividend yield is even better on the pale blue chips, right? Before I go into some back tests and some information on how these can perform, and again, this is during a time, part of these back tests are during a time when interest rates were much higher. And again, we're looking for when those interest rates begin to fall. It's going to be a search called Prima Donnas. I always like this one. Again, relative safety has to be 1.25. Relative value actually is indicated that we're looking for stocks with relative value, that growth potential below 1, less than or equal to 1. So it sounds a little counterintuitive, but what we're looking for are stocks that, yes, can grow, but not going to have the volatility, right? Again, we're looking for the dividend payout, so it's sorted by dividend yield. And this one's been performing really well over the last couple of year and a half, 2 years. And if I scroll over a bit, we'll see the dividend information. And so here it's sorted by dividend yield. So these top stocks are anywhere from 1.25 up to right now Texas Instruments is at 2.65. I'll put the stream on, make sure that these are the top stocks. Yep. So that's what we're looking at here. And again, we're looking at stocks with a high relative safety as well. So this one's been performing well in our portfolios. Let's go ahead and take a look, and we'll wrap this up by talking about a couple of portfolios just to show you the potential behind these. And again, the last year and a half or so, you'll see that this has been moving sideways on the blue chip dividend payers. This is a little over 10 years that we've been looking at this particular model portfolio. We're currently up over 180, almost 187%. This does not include the dividends that have been paid out over that time frame, although I have calculated up to somewhere between $70,000 and $80,000 of dividends, and that wouldn't even include reinvesting those dividends, right? Which is really the most important part, the compounding, the power of compounding these dividends and reinvesting. So that's what we're looking at. So we've got some great capital appreciation along with the dividends, averaging roughly 18 or 19% annualized rate of return. Remember, we're looking towards the income-minded investor. These stocks, these portfolios, you're not going to get your 5 and 10 baggers here. 80, 90% annualized rate of return. It's just not going to happen. But for the more prudent investor who is returning 18, 19, 20%, or just in the low 20% annualized rate of return over time, those are pretty good numbers. I'll leave that at that. Those are really good numbers. Now, the last one I want to look at is prima donnas. This is one we put into place recently in our retirement coaching group. This is began back in January, a confirmed call back in January of 2023. It's not quite, almost a 2-year look back. We've had some volatility in the markets, as we know, but I really like the performance of this. I kept the parameters so basic, just to show you, to build and manage your dividend portfolio it doesn't have to be complicated. So let's take a look at the details of the investment plan. It can't be more simple. We use prima donnas from the conservative folder. I use rec equals sell. We're going to maintain 10 positions. Right? We're using the confirmed up as our time to enter. Although as the market rises, there's no problem with maybe incrementally entering into these positions as the market continues to rise. Right? And the one real parameter here that we're using is max stocks per sector. I keep down to 3. I don't want you to be overexposed in any one sector. So it's as basic as that can be. So prima donna's up 58.76%. And again, I'm using the confirm calls and rec equals sell. It's a little different investment parameters than we use in our retirement coaching group. It's actually a little simpler, just using the rec equals sell. So that's what we're looking at here. These are the type of numbers. And again, this does not include the dividend payouts that you would have received over the last 2 years, or the power of compounding them if you choose to reinvest them. So my goal here was to give you just an overview of the environment that we're entering into to help prepare the income-minded investor of how you can use VectorVest to find these quality stocks. I pointed out some searches and some watch lists. Of course, we're going to be sure, and the more prudent, conservative-minded investor is going to be sure that the market is moving in the direction we need it. We are in a confirmed call right now. Entering in incrementally, I think, is a great way to do it, to build these portfolios. And so, again, as Dr. D said, the best of all worlds, right? Collecting dividend checks while prices of your stocks go up. It comes from finding these solid growth stocks that pay dividends. VectorVest is ideally suited to find these babies, Dr. D said, and hopefully I was able to show you how to use the power of VectorVest to do just that. Thank you so much for taking the time, and we'll see you next time.